Imagine a financial empire operating in the shadows, larger than many countries' economies, yet invisible to most. It's not the banks on Main Street, it's private credit, a $1.7 trillion machine that's reshaping how money flows on Wall Street. But behind the boom, who pulls the strings? And what happens when the cracks appear? Welcome to Money Unmasked. Today we expose private credit, the mechanisms driving its explosion, the hidden risks, and the steps you can take to safeguard your sovereignty in a system built on opacity. Let's strip away the complexity. Private credit is straightforward. It's when wealthy institutions and funds lend money directly to businesses, bypassing traditional banks and their regulations. No public stock exchanges, no FDIC guarantees, just private deals in the dark. Think of it like this. A mid-sized company needs cash but can't get a bank loan due to strict post-crisis rules. Enter private credit funds. They step in with loans at higher interest rates, often 10–15%. These funds raise capital from big players like pension plans, insurance companies, and even indirectly from your retirement accounts. The appeal? Speed and flexibility. But the trade-off is secrecy. These deals aren't scrutinized like bank loans, creating a parallel universe of finance. This isn't niche anymore. As of 2025, private credit has ballooned to about $1.7 trillion in assets under management, up from just $1 trillion in 2020, a 70% surge in 5 years. Projections show it hitting $2.6 trillion by 2029, driven by low interest rates and banks pulling back. To understand the boom, we need history without the spin. It all traces back to the 2008 financial meltdown. Governments clamped down on banks with rules like Dodd-Frank, making it harder and costlier for them to lend to riskier businesses. Banks retreated, creating a vacuum. Private credit funds, often run by hedge fund giants like Blackstone and Apollo, filled it. They weren't bound by the same regs, so they could lend freely. By 2010, the market was already doubling every few years. Fast forward to the pandemic. In 2020, as economies locked down, private credit proved resilient. Funds like Ares Management deployed billions in rescue loans, charging premium rates while banks hesitated. But here's a receipt. During that chaos, some funds froze investor withdrawals, locking money in for months. It was a preview of the risks. Today, in 2025, the U.S. slice alone nears $1.3 trillion, rivaling the syndicated loan market. Globally, it's expanding into Europe and Asia, with players like KKR amassing dry powder, unspent cash, topping $200 billion, waiting for deals. Narrator. Now the core mechanisms, no rumors, just facts. Funds raise money from institutional investors, promising steady returns of 8 to 12%. They lend to companies, often private equity-backed firms, in deals structured as senior debt or mezzanine loans. Incentives drive it all. Fund managers pocket hefty fees, typically 1.5 to 2% on assets plus 20% of profits. For a $10 billion fund, that's millions up front, win or lose. But borrowers pay the price. Higher rates mean more debt burdens. And if rates fall, as they're doing in 2025, refinancing booms but defaults lurk if the economy stutters. Real example, take the 2023 regional bank crisis. When Silicon Valley Bank collapsed, private credit funds swooped in, lending to tech firms that banks shunned. Blackstone's credit arm grew 20% that year alone. Another, in healthcare, private credit has fueled buyouts of hospitals, loading them with debt. When revenues dip, services suffer, wealth extracts upward while communities pay. The shadow? This ties into broader shadow banking. Non-bank lenders now hold 50% of U.S. corporate debt, per Fed data. It's efficient, sure, but opaque, with limited oversight. Why unmask this now? Because booms hide busts. Private credit props up zombie companies, firms barely solvent sustained by cheap loans. With $1.7 trillion at play, a downturn could cascade. Receipt: defaults are rising, up 20% in 2024 amid high rates. In a recession, losses hit investors last, but managers' cash fees first. It's classic wealth transfer. Elites exit early, Everyday folks in linked pensions absorb the pain. Think 2008 Redux, but stealthier. Regulators warn of systemic risks. Boston Fed notes potential instability as the market hits $1 trillion in the US. And with crowding, too much money chasing deals, yields drop, pushing riskier bets. Your stake? If your 401k or IRA dips into alternative funds, you're exposed. The system keeps you compliant by obscuring these ties. But knowledge is your shield. Here's how to reclaim agency. Concrete steps, no fluff. First, audit your exposure. Log into your brokerage app. Use free tools like Morningstar or Vanguard's Analyzer. Search for private credit or alternative debt in fund holdings. If it's over 10%, reconsider. Second, diversify smartly. Move beyond stocks. Allocate 5 to 10% to tangible assets like physical gold via ETFs or self-custodied crypto. Avoid over-reliance on illiquid funds. Third, read the fine print. In disclosures, flag lockup periods, times you can't withdraw, or redemption gates. If a fund says quarterly liquidity, that's code for potential freezes. Fourth, build a buffer. Aim for 6-12 months cash and high-yield savings yielding 4 to 5% now. It counters inflation and gives options during crises. Fifth, advocate and educate. Join forums like Reddit's r/personal finance or follow indie analysts on X. Question your advisor. What's my private credit risk? Pressure for transparency. These aren't get-rich schemes, they're defenses for autonomy in a rigged game. Private credit's shadow empire thrives on confusion, but clarity cuts through. You've got the receipts and tools now. Protect your sovereignty. If this resonated, hit subscribe, share with a skeptic, and drop your questions below. Money Unmasked. Because clarity is the only real currency.